Hello, everyone. I'm Ted Oakley, Managing Partner at Oxbow, and we are always glad and fortunate to have Danielle DiMartino Booth, CEO and Chief Strategist, really, at the Quill. Danielle, so glad to have you back, especially right now.
Especially right now, Ted. It's been an interesting 48 hours since Jay Powell took to the podium or so. Yeah.
And Danielle, I need to ask you a question. I'm going to ask you something. You are hard to interview. You know why?
Why?
Because you have so much information that in order for us to distill it down into an interview, it's unbelievable. And with that, I would tell everybody, if you really want to get it all, you need to take the quill or the feather, which we'll show here, and you can take it in. But I will tell you, we could talk to you for 4 hours, but we're not going to. Anyway, tell us what's happening here with the Fed.
So it's interesting because my former insider self, I usually try and keep somewhere on the sidelines because you get the equivalent of PTSD if I think too hard about my days at the Fed. But this last week in particular, I've been remembering what life was like when we prepared President Fisher to go to Washington in advance of these FOMC meetings. And I put myself in the position of Patrick Harker of the Philadelphia Fed and his staff and what they presented to him last Friday before he traveled to Washington, D.C. And they would have presented him with two things. They would have presented him with benchmark revisions to non-farm payrolls on a state by state level. This is what the Philadelphia Fed does. They would have said, sir, what's been reported to the U.S. public for 2022, about 1.1 trillion, just north of that is actually 10,000. Now that we've gone back and actually looked at the data and washed out the seasonality and the assumptions, when we actually got down to brass tacks of actual human job creation, it went from 1.1 million to 10,000. So that data was public data on Tuesday. And even if it wasn't public, he would have been obligated to report this to Chair Powell at the FOMC meeting. He would have also been obligated to report, as the Dallas Fed has already reported to Chair Powell, what the Dallas Fed manufacturing survey results were. That's classified information until it's released to the public, but you still tell the chair about it. So Patrick Harker, we put the Philadelphia Fed work week in today's feather. He would have been obligated to tell him that the current work week has slid into contraction and that major layoffs are in train. In the oldest data back to 1968, that is the oldest Federal Reserve survey. It is the beginning of the manufacturing pipeline, chemicals. That is the chemical hub of the United States, southern New Jersey, part of the Philadelphia Fed. So going into the press conference, as well as the fact that one of the other feather charts today, Jay Powell has been harping on core services net of shelter, which he at the podium said was 55% of the core PCE, which drives policymaking. He said that form of inflation remains much too hot, and it is a reflection of wage inflation and how tight the labor market is. So we did him a favor in today's feather. We graphed it out. Last 12 months, 6.1% increase, much too high. Last 6 months, moving average, 5.1. Last 3 months, 4.7. He had all of this data in hand when he took to the podium and chose to lie to the American public. And that is not a word that I use. It's not a word that I would use lightly. I'm a God-fearing Christian woman. But he had all of the data in hand, stood up and just lied. And if he wants to crush the Fed put and make price discovery great again, then say what your real aim is, and don't lie about data you have in hand.
Mm-hmm. Do you think he wants to get back to the old days, to normalize, basically? You think that's where he's headed?
I think that's where he's headed. And I've said publicly that they would have to change the name of the Eccles building to the Powell building in Washington, D.C. if he achieves that. If you take investors out of the driver's seat, because since Alan Greenspan on October the 20th, 1987, since he allowed investors to begin making monetary policy instead of the Fed, really, the Fed has just been a spectator. and doing the market's bidding. If he was to wrench back the control of monetary policy and put that back in the hands of Federal Reserve policymakers for them to guide the U.S. economy instead of Wall Street guiding the U.S. economy, he would be a national hero.
Don't you think it's unfortunate, too, that I said this all along, when you're running money policy, in favor of the stock market, that's your whole key variable. Do you ever think about if we'd ever had any decent fiscal policy, maybe they wouldn't have had to hand the entire ball off to the Fed and have them do everything?
So Ted, we go all the way back, Ted. So, I left, I followed Richard Fisher out the door on June the 12th, 2015. And 6 days later, I published my first weekly quill. And the word abdication was in the title. And I wrote about Congress abdicating its duty to the American public and constituency and handing that duty off to the Fed. And what a crime that was on the fiscal side. That was the first thing I ever chose to write. Those were my biggest reflections of having been inside the Federal Reserve for 9 years, is why on earth can't our elected officials do their jobs? Why have they pushed everything off on Greenspan, Bernanke? Why? That was first and foremost in my mind, and I wrote about that first, the abdication of their authority.
So if you had to say today, and looking forward, where do you think the chairman is on fortitude to actually do a Volcker type thing? You think he has that? You think he can do that?
Well, he's first of all, Volcker had Reagan in his pocket. And we forget that context. We forget that debt to GDP was 30% and that Reagan was able to blow up the deficit and really not have consequences, which it made Volcker's job doable at the time. And nobody talks about that. Today, we've got 130% debt to GDP. Now, the GOP-led House of Representatives cannot be understated in how important it is to Powell's potential mission here. And on top of that, there's a very curious development that I've witnessed in the last few weeks, because Lael Brainerd, who did not win out to become Powell's replacement, has started her dovish campaigning again, hoping that she can replace Janet Yellen as Treasury Secretary. In the face of that, John Williams of the New York Fed, who's the other vice chair. So Lael Brainerd is vice chair of the Federal Reserve Board. John Williams is vice chair of the Federal Open Market Committee with a permanent vote as president of the New York Fed. He was raised, if you will, by Janet Yellen. He was the former head of the San Francisco Federal Reserve, the most dovish in the entire 12 districts. He has stood by Powell. He has chosen to refute, deny, suppress his true dove in favor of being the lieutenant who stands by Powell's side despite his dovish leanings. Why is that important, Ted? Because Neil Kashkari, Lori Logan, who's at the Federal Reserve Bank of Dallas now, who's a career Fed economist, huge dove. There's a third dove that rolls on, and then Patrick Harker from Philadelphia is kind of neutral. But Jim Bullard is going away. Loretta Mester is going away. Esther George is going away completely. She's leaving the Fed system. The three hawks are rotating off of voting, starting with this January 31, February 1 meeting. There was this off chance that Powell was only going to have two supporters among all the voting members in 2023, just Christopher Waller and Patrick Harker of the Philadelphia Fed. And yet John Williams decided to stand by his man despite being hawkish. Came out today, the New York Fed came out with a CPI forecast of 5%, knowing full well that inflation is going to be lower than that. So they gave Powell a present so he can go into the new year saying, according to New York Fed research, inflation is going to remain high throughout 2023. I'm going to continue on my merry way with my wrecking ball. I'm going to lower the pace of rate hikes, and I'm going to be very quiet, and I'm going to keep the press pool gagged Still, principal's been gagged for 6 months and not allow them to ask me about quantitative tightening.
So let me ask you, do you think that it's realistic to assume he could ever get back to 2% inflation, or do you think they would have to reset?
I think that the scariest part of the equation is that they could get back to 2%, or they could even get back to 2.5% by the end of the year. He said it at the podium. There was his honest moment. He said that he knew that housing inflation was going to remain sticky going into 2023, but by the same token, he knew that it was going to cool in 2023. And he said, but that doesn't matter. What matters is wage inflation. But the fact is that's a 30% input to the CPI. And by this time next year, you're at ground zero. Or if you were coming to me from Boise, you would be at the other ground zero. But Austin, Boise, Raleigh, the Research Triangle, North Carolina, home prices are coming down so fast and so hard that a year from now, if we're even close to 2%, Ted, the depth of the recession is going to be something that puts 2009 out of the history books.
And don't you think most people are in denial on that right now?
Oh, gosh. You want to know what denial looks like. When the U.S. economy contracted in Q1 and Q2 successively, the National Bureau of Economic Research came out. They score recessions. They came out and they said, this is not a big deal. These are inventory adjustments. This is global trade, fade. And then Q3 printed at positive 2.9%, and they didn't say a word because it was only exports. It was just the war in Ukraine pumping up natural gas exports. So the NBER has been curiously silent. We wrote about this a few days ago, and this was before retail sales came out disappointing, the portion of retail sales that feeds into GDP, before industrial production printed negative, that feeds into GDP, before business inventories disappointed. All I'm saying is, before that happened, in a $23 trillion economy, we were $40 billion away from the NBER, according to how they score recessions, saying recession started January 1, 2022. We're there.
So,
and people have no idea.
So you've written, obviously, and talked extensively about employment, unemployment, too. Where do you think we're headed here with all of that? And you've got a couple of slides relative to that, too, but I'm just curious what you're thinking.
So, I think with Thursday's price action in the markets, I think somebody on Wall Street rang a bell and said, okay, the party's over. Last weekend, when we found out that Bank of America's Brian Moynihan was in the running for Treasury Secretary, that finally explained why he kept saying the consumer's strong. So, because the consumer's not strong. But this morning, somebody, after the close of business yesterday, somebody at Goldman Sachs said, we can't pretend anymore. It can't be hundreds of job cuts. So first thing I see on the wires, dark 30 this morning, is Goldman Sachs is laying off 4,000. They set the pace. Silicon Valley's a train wreck. They realize they've got so much fat that Elon Musk managed to keep Twitter alive, not monetarily. I mean, he's losing money. But everybody said, oh my gosh, the World Cup is coming. Twitter's going to shut down on that Sunday, 2 Sundays ago. Nothing happened. It's so scary that Silicon Valley is able to operate with basically a skeletal staff and still be operational. So the bloom is off that rose, and now Wall Street is capitulating, and there's going to be blood in the street. So we're no longer going to hide behind, oh, the layoffs are one-off or in one industry. You have factories closing. You have Amazon closing entire distribution centers. And now we have such a broadening, and now you've got this $1 million revision to non-farm payrolls. So it's no longer going to be this, you can hide behind the labor market into 2023 and begin to suggest that we might have a softish landing. That's gone, and it's in the data. Continuing jobless claims, and that is the number of Americans collecting unemployment insurance. When you're collecting unemployment insurance week after week, that means you can't find a job. So that troughed on May the 21st, and since then we're up 28%.
So let me ask you this. I'm curious. Now I've had this personal experience. Okay, I've had people. I know 3 people over 50 that had been laid off. A couple were in the tech and somewhere else, but it was white collar basically, and they have not gotten another job yet. Are you seeing that? I mean, that's something we're starting to notice.
The phenomena that makes the current episode so unique, and you have a better prism into this, Ted, than I do, because you see the black market in the food stamp program. So what's unique about the current cycle is that layoff cycles always begin with the lowest income earners, always, until this particular episode, because we haven't, last year's 25% increase in food stamps, October 2021, was compounded by another one of equal magnitude this October of 2022. So the lowest income earners still can squeak by on the math of staying out of this workforce. And that's why we're seeing record levels. I spoke to the individual who tracks small business closings a few days ago. He has not seen small businesses closing at this pace since 2009. Because they can't get workers, and the workers they can get, they can't pay. But this particular layoff cycle has been a white collar recession. And outside of the state of California, which is the biggest in the country, most states will not pay you unemployment insurance until your severance runs out. So we haven't seen all of these white collar layoffs manifest in the formal labor market data because they're collecting severance. That only typically lasts for about 3 months. And that's why we're seeing the numbers begin to pick up.
So I'm going to shift over to housing. And you've got, and while you're talking, you have a number of really great slides here on what's going on in CRE and housing in general and that sort of thing. And this is another one I see. I tell you, if you look at the banks and people in the industry, everybody seems to be in denial on this one too, though.
Well, Tad, I think the denial is. I think the denial has several sources. It's very hard to get the realtor community down off their bidding more sugar high from 2021. So they want to go back to the glory days very badly. So they're misleading sellers. So you have not had a full-blown seller capitulation. They keep saying falling mortgage rates are going to come in and save the day. Well, in speaking with Ivy Zellman, guess what? Not having a job trumps falling mortgage rates every time, every cycle. And that's where we are today. Nevertheless, what we have is, I wrote it a few weeks ago about commercial real estate, but it equally applies to housing residential. And we've got the standoff at the OK Corral. And people in the marketplace are petrified about creating comps. If you're going to go buy a second home in Hilton Head, first thing you do is you look at the comps and you see where houses have been trading. The realtor community and the lending community, they're all petrified of there being comps out there, because then if you're an Airbnb jock and you're one of the few outside of investors, private equity investors, big institutional investors, once those comps start to come in, as the lender, you're going to have to go tap, tap, tap on the shoulder of these Airbnb people who didn't put any money down buying all of these multiple homes all over the place. They had different lending standards during the current cycle, and they will be the first forced sellers. And the lending community's scared stiff about them. The realtor community is scared stiff about losing their living. So you've got these two sources that are attempting to slow this train down. And then you've got wild man Jay Powell up in Washington, D.C., trying to make sure that he at least, at a minimum, keeps mortgage rates steadily at a high level. This will come crashing down, I think, in the first and second quarters, and it will be led by commercial real estate, but it will bleed into residential.
Well, you have a slide about how commercial real estate, where maturities now coming up, and that's going to be a big threat to the system. It's
I sat down with Dan McNamara, Polpo Capital. He specifically invests using commercial mortgage-backed securities and different tranches. And he's really got and he went through the 07, 08 episode in commercial real estate. And his bottom line was, the Fed came right into the rescue, and we were able to underwrite all of that paper, extend it out. And the market was really only closed for a hot minute. And then it came roaring back. He's like, we have in 2023, we have paper that was underwritten between 2010 and 2012. In other words, we've already come through the extend and pretend on that vintage of 10-year paper. And they kept saying, let's just get past this pandemic. Let's get the economy reopened. Let's make sure we stay at the zero bound. Let's make sure the Fed doesn't raise interest rates. And then we can re-underwrite this 10-year paper. 2023, it's not happening. And to use a word that he used so many times when we spoke for an hour, there's a structural shift in office space that's not going to be refilled. So underwriters know that they're going to have to take a massive haircut in order to value office because they're not going to be refilled unless they're A-plus properties. And this is a nationwide phenomenon. So, and in addition to that, they've all got 2% cap rates sitting on them. And it really is more like a 6 or 7. So, but he said this will happen. And one of the drivers I wrote about a few weeks ago is the Chinese development community. They're being forced to sell buildings. They sold a multifamily high-rise in Los Angeles for $504 million recently. They had $700 million in it to develop it and couldn't sell it for 18 months. But everything went so bad for them in China that they're actually having to come to the United States and start to liquidate their trophy assets. And it's scaring the dickens out of American consumers. And we saw that with Blackstone putting a gate up on their REIT.
Let me ask you, too, you have a great slide on pensions. I'm assuming that a lot of these pensions have a lot of that debt.
So before there was private credit, there was private real estate. So, and there were a few years there that you could track one pension after another piling into private equity-backed real estate. So as bad as the B REIT is, because it gets headlines because it's a publicly traded entity, even though it's anyways, as bad as the public is with B REITs, Lord, the public pensions are knee deep in it. But at some point, some manager said, I think we've hit our cap on real estate. At which point, the private equity community said, we'll take care of you. We're going to invent this private debt thing. So we're gonna invent a whole new. So small and medium enterprises. I hope you can put that slide up. Small and medium enterprises entered the pandemic the most levered, as opposed to larger companies that really got hurt during the financial crisis. So into this fray steps private equity. And whether it's funeral homes, your local dry cleaner, your nursing home, you would be surprised, convenience stores, you'd be shocked to know that we think of Guardians at the Gate, we think of RJR Nabisco, we think of multi-billion-dollar leveraged buyouts. They've been in your local communities, levering these companies up and selling 68% of it, 68% owned by U.S. public pensions. And that's the other gate that Blackstone threw another gate up for its private debt fund.
Thank you, consultants, right? I mean, that's where they have to all chase each other.
The one thing that Charlie Munger said to me in 2005, he said, I probably won't live to see the day, but you will live to see the day that the pension consulting community is put out of business.
Well, you would hope so, because they really don't add that much value. And then on private equity side, let's face it, that's been a protected group in every manner for the last 15 years. And if you could pull back the covers and look at this group here, people, I think, have no idea what goes on in that industry.
They don't. And, this is, to me at least, Ted, you bring up the most important the most important challenge for 2023. And that is that when there was a Main Street lending facility post-COVID, it was an off-balance sheet vehicle that the Fed had access to. They were able to backstop even holding companies of private equity firms. My head blew up when Jay Powell expanded the umbrella to include his buddies from Carlyle's holding companies. So the mark to market never had to happen. I jokingly said a few days ago, he's sending private equity straight to voicemail. And the public pension community is starting to make rumblings that they're going to have to mark to market in Q1 or Q2. They've never had to mark to market, ever. And if they start marking down these private equity holdings, it will be, and again, Goldman Sachs is at the front line and they see what's coming. And after the retail sales data disappointed so much, there's no more lying. They know Jay Powell lied. And Goldman Sachs, of all, knows that these private equity firms are in the crosshairs.
And the other thing, Danielle, if you look back 15 years ago, you had, your minimum to go in was $250 or $500 grand. They've ratcheted all those things down to where somebody with, $2,500 or $5 grand can go in. And so they've got all the public into these private REITs too. At the same time, they're going to, get in trouble. Yeah,
and it was sold the same way. You absolutely need to be diversified so that if something happens with your public market holdings, you're hedged. And the sad thing is that it's retirees or pensioners, but it's still highly inappropriate vehicles for retirees to be in, whether they're backed by a public pension or if it's something they're owning in their 401k.
And I've said this to a number of foundations we manage for in various things. I said, look, a lot of private equity and private REITs, I said, you have no idea what it's worth because they won't market to market. So, you don't know what it's worth, and you'll know when you want to try to get out, which is what's going on right now. But that's where we are. Interesting. That'll fold into my next question is stock markets, and where you had some great slides on where we were and where we were going, because obviously, this really was, and I've been around, 4 decades or more, and was the biggest bubble I've ever seen in everything.
Well, the reason I keep putting that Kay Schiller slide up is just to show we haven't corrected. The stock market hasn't corrected. The stock market is still very overvalued, historically speaking. This is no 1981 event. You're still closer to 30 than you are to 25 on the price to earnings ratio. And in 1981, it was 8. So
yeah. And earnings have just started down. So that number's even going higher.
and that's people, and earnings have just started going down. There's an undeniability about numerators and denominators, right? And investors are, and that's why when you see somebody like a JP Morgan, who's been bullish, their chief equity strategist. When you see somebody like him come out beginning of this week and finally capitulate and say, oh, okay, we really are going to have an earnings recession. I'm finally no longer a bull. It used to be Mike Wilson of Morgan Stanley was kind of left out there in the cold to speak honestly. But when you start seeing big Wall Street bulls, the big strategists come in and capitulate, you know what's to come. And right now, I was just in New York. They're all out there partying like crazy. So you're not seeing reflected in the stock market right now. It's very bumpy. It's very ugly. But wait until the hangover wears off and they're at their trading desk on January the 2nd, 2023, and they didn't get the bonus that they wanted. They're relieved they've got their jobs, but they better trade according to reality, not according to fantasy.
Yeah, along that line, let me ask you, have you ever seen the desperation to catch a market low or an interest rate high that you have in the last 3 or 4 months?
It is this I call it impulsiveness, because at some point you've got to attach a psychological term to it. This absolute need to, there's the pivot. On November the 30th, Jay Powell got on stage with David Wessel. It was, no offense, Ted, but it was 2 uptight white men. So there wasn't going to be anything combative between 2 cordial gentlemen dressed in suits. It wasn't ever going to happen. And so people were like, that's it. Look at how nice and sweet he was. He was nice and sweet at the podium on Wednesday afternoon as well. But what he said was not in any way polite. Well, it was polite, but it wasn't nice for investors. And everybody's like, oh, look at this data point. Look at that data point. Surely they pivot now. And he knows it. So he's resorted to the last resort of lying.
So, we tend to think, that real estate is a lag item. So, you're going to see worse coming. And That's what it looks like to us, and really in the market as well. One of the things we find is that people, you're talking about the markets, they're down, in their investments, but they're like, it'll be okay. They're almost remembering the Fed will bail me out. And it doesn't look like this time to us, does it you?
No, and I think the most important aspect is the runoff in the balance sheet. My mentor, Lacey Hunt, he directs me to follow the Fed's H8 that is released every Friday after the close. And we ran the data. You've got the slide. We ran the data back to 1973 when the series originated. It's a weekly series, and it is the broadest measure of money supply because the Fed quit reporting it on a regular basis. So we've been tracking that. And though you had lower points for a hot minute in 1974 and 1981, we've never seen 6 consecutive weeks of such negativity in this entire data series back to 1973. This is a half-century series, and we've never seen 6 weeks of this. And the important thing to know is that Jay Powell keeps telling you that he's going to keep interest rates high. So it doesn't matter if you only get 25 basis points in February, March, and June. If he can succeed in doing that, what's important is he's going to keep up that $95 billion a month run rate that the ECB's just piled onto and keep taking liquidity out of the system. That's what's key to watch. And if he could pull that off for the next 12 months, I might have to tell him that I forgive him for lying and that maybe he should take his Protestant self to the confessional and be absolved.
Well, I don't know which Wall Street genius dreamed up the word pivot, but pivot to us is declining. It's not stopping.
It's easing. It's restarting quantitative easing. It's lowering interest rates. And he said, I quoted it in the Feather that you're going to share with everybody. He said at the podium, we are not going to consider increasing the inflation target as my peers at the European Central Bank have. We're not. It's 2%, 2%, 2%, or 2%. And his message there is we're going to stay the course. So don't look for the pivot.
I have 2 final questions for you that really...
There's no way we run out of time. No way at all.
Okay, we'll go a little longer then, because like I told you at the beginning, if you want to get everything you do, you got to take the feather or the quill, because there's too much. You'd never get it all in an interview, and that's why we've been running this stream at the bottom so you can take it. You've got a great service, and I love your writing, best writer I've ever known. But I want to ask you something about, if you look at a so-called quote unquote asset class, which there's about 5 or 6 of these that we don't think are assets at all, by the way, okay? If you go from crypto to NFT to SPAC, you go down the list, okay? All the companies that do only revenues. How do you think people got to that point? In other words, we have this area where people, and we've seen a lot of, I think it will, in the end, I think it will dwarf the Madoff situation. So we'll just see. I'm just curious.
So I had the incredible privilege of sitting down with William White yesterday, and he started at the Bank of England, the Bank of Canada, the OECD, the Bank of International Settlements. He's considered to be one of the godfathers of central banking, and he's honest.
That was a great interview, by the way. I watched it.
Thank you.
Yeah.
And he's just so composed. And he just explains that these SPACs and these NFTs and crypto, he's like, they're emblematic of the Fed pushing lower for longer each time.
Yeah.
He said, so of course, this time around, the mania manifested in a bigger way and in multiple ways compared to where it was. Because you can't just talk about crypto or Sam Bankman-Fried. You also have to talk about celebrity-backed SPACs or Snoop Dogg's NFT. There were several different pockets of this mania or meme stocks, GameStop, trading based on chat rooms. Normally a crazy investment bubble ends with one. We can name like 5.
So you didn't buy one of Snoop's metaverse lots for $500,000?
No, I did not. I didn't think that buying the metaverse house blueprint on Mars had value.
Yeah.
Because I don't think I'm too old to get to Mars. So, but it was a meta. So no.
But
I admit it, I'm not smart enough.
But it really does have more to go, though.
Yes. Oh my gosh. Look, there are still several. I mean, you can still go on PayPal and transact in Bitcoin. I mean, it still has room to run, and there are still professional entities out there who track Bitcoin and trade it when it's inside of a range. They know that the dumb money is going to get completely annihilated in the end, but they still trade it enough for people to go, see, it's legitimate.
There's a website, and I believe, I may be wrong, and I believe it's coinmarketcap.com. There's still 9,400 coins. 9,400. Now, forget about Bitcoin and Ethereum and the next 3 or 4, but 9,400. Think about everything from 100 down, okay, what's going to happen. And I think people are not, and unfortunately, it's a lot of young people. Last question for you. And you've been in the business, been around the business, consulted a lot of businesses. We have a theory that since 2009, particularly, this investment industry all over, okay, is probably has at least 50% of the people that have come in, 45 to 50 since that time. And our opinion, okay, is they know very little about the true investment business. In other words, they're sent down from on high to buy 8 things or 11 things, and we're in good shape, you're there for the long run. But when you get right down to income statements, balance sheets, you see it that way?
I think Portfolio Management 101 at the Macomb School, everybody needs to go get a course from Dr. Keith Brown. And by the way, take managerial accounting at the business school there, because best accounting program in the country still to this day. What I had to go through in business school and dissecting and slicing income statements and profit and losses and balance sheets and pension accounting. What's funny is they can say the word diversity, but they couldn't find an efficient frontier if you handed it to them on a calculator and never made them figure out how to actually had to derive that formula. Yeah. But they're drones. They're automated. They're paid specifically to not think. If they think, they get fired. Yeah. And I mean, I'll never forget, I wouldn't put my clients when I was in Wall Street. I had a few clients and they're like, you must put them in the NASDAQ. And I'm like, no, I won't, not in 1999. I'm so sorry. But they're like, but this is a firm specific product. And I'm like, I don't care. So, but you know what? My clients didn't lose a penny. They were in triple tax exempt municipal bonds, and they were fine.
So, listen, I want to thank you. I want to throw something out sometime, and I love this guy too. I love Lacey Hunt. Sometimes I want to try to get you and Lacey on together, because that would be the show of all shows for us. Well,
I'm down in Austin from time to time.
I know.
So I would love to actually do that in person. That would be. Yeah. And it'd be ideal to do it after that February the 1st meeting, because the world thinks that after that, the world thinks it's going to be the last rate hike.
I know you talk to him more than I do. We'll talk to him for sure. But listen, I want to thank you. And by the way, and I was serious about this, really check out that we're going to send out that piece that you so nicely are going to lay in behind this. I thought it was a great piece, by the way, too. And I would tell everyone, that, again, I think your service has come around so much. And for the feather and the quill, they do different things, but we get them both. But thank you so much. We appreciate it. And listen, I'll send you some Christmas music.
Oh, yay.
Over the internet. Yeah, I picked out the music myself, so if you don't like it, just blame me.
No. There's not been a bad year yet. Let's put it that way.
All right, listen, thanks a lot, and we're gonna see you next year.
I will see you next year. Happy holidays, Ted.
All right, thank you. Bye-bye.